In an environment where interest rates are continuing to rise, suddenly raising venture capital is not as easy as it used to be. In fact, it's getting a lot more difficult. However, there are always investors who are looking for interesting opportunities. The key now is knowing how to find them. I'm Jane Singer, and it's great to have you as part of our global community of industry leaders here on A Seat at the Table. Today we're joined by Ron Bauer, founder of Theseus Capital Ltd, principal investor in a number of science and technology companies, and author of Capital, Raising Money in a Digital World. Ron's helped and managed 5 IPOs to raise over $200 million and scale their businesses. In this podcast, he'll share how performance expectations for startups have changed in the past year from an investor's point of view, how any entrepreneur can reach new investors and raise the capital they need, even if you're not slated to be the next unicorn, and classic mistakes founders make when pitching investors that can cost them the deal. One of the most important investments any company can make is in top talent. Even the best products in the fastest growing markets need the right people in order to deliver on goals and drive sales and profits. Finding these people can be as difficult or even more difficult than another round of financing or negotiating with your bank. That's why top corporations and even smaller enterprises rely on AsiaNet consultants to help them fill those key positions. Since 1988, AsiaNet has been working in partnership with its global clients to help them make the right strategic hires. They have a well-earned reputation for being able to fill even those difficult-to-fill positions. So if you need to recruit new talent, or you think you might be doing that soon, head on over to their website. That's AsiaNetConsultants.com. AsiaNetConsultants.com. I'll leave a link in the show notes. Now let's sit down with Ron and find out where we can find that next round of funding. Ron, I'm really happy that you're able to join us on A Seat at the Table. I think that the whole topic of startups and venture capital has been such an overwhelmingly big topic, and now that we see a lot of shifts coming through in the economy, I think it's continuing to be a big topic. So thanks for being with us today.
No, thank you so much for having me. I appreciate it. Thank you.
I think maybe we'll just dive in. As you look at startups and raising venture capital to fund them, this has mushroomed in the past 2 decades, and now it seems that the market is shifting. It seems that investors are starting to focus a bit more on profits as well as growth or scaling. Rates clearly have started to rise and look set to continue to do so, at least for a few quarters going forward. In your opinion, what, if anything, has changed from an investor's point of view? Have the criteria and expectations for funding startups shifted? And if they have, in what way?
I think the whole economy has changed. Globally. If you can't see that as an investor or as a founder, let's first step back. If you can't see that as a founder of a company or a CEO, that the entire global economy has shifted literally in the span of a few months, then you've been hiding under a rock somewhere or not in tune with reality. It's just $1 today is like $100 a few months ago for a startup company. It's almost, IPO levels have gone down dramatically. Stocks being taken public have gone down 90%. IPOs are going to be, lower than they were pre-pandemic or during the pandemic. It's just become very difficult to raise capital. I think the economy and the current climate right now has made it very difficult. I think that people are looking now you're seeing a dramatic shift, looking for startups that are generating revenue already. People are saying if the company does not have, at least in my case, people that I deal with who are investing in early stage startups or growth companies are telling me, they're saying, don't come to me unless there's revenue, unless there's proof of concept. We're not interested in pre-revenue deals anymore. So I think the landscape has changed, and it's going to be extremely difficult for people with back of the envelope ideas, startup ideas, to raise any money.
There are a lot of startups that have been quite successful at generating revenue, and they continue to grow sales. But year after year after year, they never manage to get profitability. And there's been increasing conversation around the fact that how long can they continue to just keep getting funded to grow sales and grow revenue without really turning the corner on profits, particularly in an environment where you have existing companies, right? Established companies that are taking a beating on Wall Street and so forth because even though they're profitable, they're not growing sales as fast.
Okay, that's a great question. And a perfect answer for that would be look at Amazon. Amazon
Right.
for many years did not turn a profit. They
Yes.
started out as an online retailer to sell books, and for probably 2 decades didn't turn a profit. And they kept raising money. They were a small IPO. A lot of people failed to realize Amazon only raised $54 million in their IPO when they went public. Now they're, one of the biggest companies in the world. So I think that if you can find a problem in the market and you can create a solution and you can get people to buy your service or buy your software or buy your product, don't worry about profitability. Worry about revenue first. Revenue is already a big thing. It's a big thing to get someone. First of all, it's a big thing to create a solution to a problem. Then it's a
Right.
big thing to get someone to actually pay for that. So don't worry about profitability. There will always be a bigger company or someone out there that can use what you create if someone else is willing to buy it, and they can do it in a more economical and efficient manner. For example, a company came to pitch me last week. They've created this robotics and automation system to package groceries for supermarkets, and it's going to revolutionize the industry. Right now it takes 45 minutes to do, they can do in like 4 or 5 minutes. It's crazy. And then their cost basis is what would cost right now $30-40 million for these grocery companies to build. These guys can do it for $2 or $3 million. And they have a proof of concept in Japan that they're building right now. But for example, the industry is against innovation. Sometimes people don't want innovation because they're making money a certain way. So
Right.
people have been trying to stop them from innovating. So I think the number one goal is when you create a business, try and find a solution to a problem and try and get people to pay for it and generate revenue. Don't worry about profitability when you have a startup. Worry about, bringing your idea or your product or your service to market and getting people to actually buy into it.
Okay, I think that's really an interesting point of view on that. Now, in the market that we're facing nowadays, where you have less what was referred to as free money, free because interest rates were basically at zero, do you see things have changed and from an investor's point of view, and in what way?
I think investors have a lot more opportunities today than they did, let's say, even 2-3 months ago.
Wow.
Everybody's looking for money, and money's harder to come by. I think the shift in the global markets, as far as stock markets, have just been in free fall, and they're up and down. And interest rates, like as you said, mortgage rates used to be 1 or 2 or 3%. They're now 6% to 8%. I spoke with someone the other week in the U.S. who was offered a 50% loan to value mortgage at 8% on
Wow.
on an expensive home. I mean, that's just insane. That's
Right.
that was hard money lending rates, not bank rates. It's
Right.
ridiculous. So I think it's a lot harder to raise money. I think there's a lot of opportunities out there. People are hesitant to, even people with lots of money and billionaires and millionaire investors, they're hesitant to write checks today in the current climate. So it's not an easy market, and I think it's going to get a lot harder too. It's going to get more difficult before it gets better.
Right, right. So then, if I'm understanding you correctly, then as a startup or as a new venture, you have to work a lot harder to be able to win that venture capital than you did, even as you're saying, a few months ago.
Well, you have to work much harder. And I mean, there's no shortage of opportunities and places to look for money. Definitely not. But I think you definitely have to be more creative. You have to think out of the box. You have to figure out who your target investor market is, and your audience, and try and reach that audience, because it is, as you say, it's getting more difficult, and investors are being inundated with multiple deals on a daily basis, and they're turning down projects unless the founders have had an exit before and they're experienced, or as you say, they're no longer pre-revenue, they're generating revenue. We don't have to worry about profitability yet, but if they're generating revenue, that's already a bonus compared to most startups. And they have to be in an area, a hot sector that's very scalable, with the ability to automate or not have hundreds or thousands of employees.
We're going to take a quick break now, and then we'll be right back.
We were hiring when we were making 50 to 100K monthly losses.
And why? Welcome to episode 1.
I can't think of a single founder who's been around for a decent amount of time in business who hasn't had their tunnel of year. This was that year. We're going to be okay, yeah, Sheree. Some are going to hear this and think, you TDP. But hear me out. You only have to do the math to understand that very soon we were $500,000 down.
Now, having raised over $200 million in venture capital for several businesses, as well as being a principal investor yourself, what are the key things that you've learned? What do founders of startups often misunderstand about raising venture capital?
I think the biggest problem that I find is that founders try to be, jack of all trade, master of nothing. It's really good to be focused. I like to invest in people that are really good at one or two things, and they're extremely focused. They're experts in one or two areas, and they can hire. You can always find people. You can find a CFO, you can find a COO, you can find someone to help you with various things with HR, etc., or your growth. But I think it's very important for founders to be focused and be very good at what they do. I think it's also the biggest problem is people invest so much money in their business, but then their investor materials they just look terrible. They look like garbage. So I'm a big believer in investing in yourself and investing in first impressions. Hire a copywriter, hire a graphic designer, hire a photographer and videographer. Don't use stock imagery. Don't use templates off the internet. I mean, you're trying to raise millions of dollars and make yourself look like the next unicorn. Invest in yourself. First impression. It's like you're going on a date with a man or a woman. You're going to invest in your appearance, how you look. The same with your business. Dress up your business the same way you would dress up yourself. Make sure all your materials look proper. Make sure numbers make sense. I've seen hundreds, if not thousands of and I've never had one deal that has met their financial projections. So be realistic in your numbers and your financial model as well. No one expects you to meet your numbers and be 100% on the ball when you're a startup. But I think the key is really be focused and invest in yourself. Make sure your business looks the best it can look.
I think those are really good points, and I think that oftentimes people do overlook that. In today's market, how can entrepreneurs or startups best reach out to potential investors? It can be a little bit of a muddy situation, right? Where people are good at what they do, as you said, but they have no experience in raising funding, so they don't really know where to go. What advice would you give them?
People say to me always, I don't know where to turn to or who to go to. That's your question is a great question. And people always come to me and say, how do I find investors? Where do I go to? I don't know who my audience is. I remember when I started out in business, almost 30 years ago now, almost, we're talking like late 90s or, early 2000 and over 20 years. There was no internet. The internet was just coming out. You couldn't go nowadays. You can go on the internet. You have these databases like, Apollo, like, PitchBook, etc. You have all these databases you can go into, and you can pinpoint through subscription the actual targeted person. You can go online and find underwriters, investment banks, brokers. You can cold call them, pitch them up, write them an email. All their contact details are on LinkedIn or online. Don't be shy to reach out to people. I'm a big believer. People are afraid of rejection.
Right,
so I
yes.
say, it's go and ask, send out 100 messages. Try to get 100 connections. 2 people say yes, you've got 2 more leads than you had the day before. You also have all these portals. You never had regulated crowdfunding portals when I started raising money. So you can go out now to portals like WeFunder or Start Engine, and you can go and structure your company in a way that you're going to hit the masses. You're going to hit thousands of people in a targeted manner. And you can raise now in the US up to $1.07 million in a crowdfunding without an audit. You can raise up to 5 million with an audit, which is a basic audit. It doesn't have to say very much. So you could be like 45 to 60 days later, you could be hitting the ground, raising up to $5 million. You now have regulation A+ offerings, which is almost like a mini IPO. It's like an IPO for a private company without being public. You can market it the same way as you market a crowdfunding portal digitally and through a regulated platform. It's a full prospectus you file, but you can raise up to 50 million through a Regulation A plus offering. And there are loads of marketing companies and regulated platforms that are regulated by FINRA and the SEC that allow you to go and target and market to, retail investors through having a, prospectus filed and approved by the SEC. So there's so many opportunities there, and you can do all of that without even leaving your office. You could be sitting in Hong Kong, Singapore, London, Berlin, LA, Miami, Toronto, Vancouver. You set up a US company, you structure your business underneath, and you can go and hire a team of consultants and organize.
Wow, that's really interesting. When you are talking about what you might call more of a micro venture, I'm probably using the wrong word to describe it, but obviously something that's raising smaller amounts of capital. You made an interesting point about the fact that you can get funding through these different portals for really what I might call, and probably using the term incorrectly, micro deals. Now, when you're trying to put together a prospectus or a pitch for something that's small, you're probably not realistically projecting the same things that you might when you're looking to position yourself as the next unicorn. Are there different criteria? Are there different ways that you would position that?
Not really. I would look at every company. You never know what's going to be the next unicorn. I mean, I started up a company in 2006. It was a small little oil company. We had a concession in Kenya. We raised, $6 million for this company to kick it off. And we were acquired by a company during the crisis that took over our concession and grew to 3 billion market cap. And they became a massive company and raised,
Wow.
$2 billion on our concession. So I've learned that you never know where you're going to find the next unicorn. And I believe I tell all the founders and CEOs I work with, act accordingly. Prepare yourself day one for either an IPO 2 or 3 years down the road. Put all the pieces of the puzzle and all the tools you need, put everything in place so you're ready to go and raise capital, whether it's, starting from your friends and family to your, angel and seed investors, to your investment clubs, to a crowdfunding portal, to the Reg A Plus, to an underwriter to do a pre-IPO and an IPO, to the institutions to do a follow-on offering. I said, I like to look at the process as an investor journey and get all the stepping stones ready. So at every stage of your business, based on your success and based on your growth, you're ready and you're prepared. It's very difficult to go back and rewrite history, but you can prepare yourself for the future if you plan accordingly. And that's always what I tell the founders that I deal with.
Right. I think that's interesting because I think most are really just in survival mode. And people just want to get to the end of this year or the end of this quarter or whatever, and they're not really thinking that far in advance.
No, I mean, and you have a strong point there, but I think even today everything is so economical to plan and to do. There's an app for everything, there's a tool for everything, there's a portal for everything. So I think you can be in survival mode and care and maintenance mode, but you can also be planning for a year down the road, 2 years down the road. People, the last thing I want to do is if someone comes to me and says, we're just trying to stay alive, I'm like, sorry, I'm not giving you any money and I'm not raising your money. The last thing I want to do is take good money and put it after bad money. That's
right.
The biggest mistake. So I'm always looking for people that are planning forward and looking for, how to grow the business, not just survive.
Right, right. I think it's an interesting point, and I think that one of the challenges that people face when they're startups and they've raised money, particularly if they're relatively new at it, is how much do you try to raise? Do you take it and try to throw it all at the business immediately and see if you can make it scale as fast as possible? Or do you try to budget it a bit more so you don't run out of runway? I know that could be very different in each situation, but I've seen startups that have taken both approaches, and some of them just burning through money really fast, but they say, hey, we got to just try to do everything we can to scale as fast as possible. And others are a bit more conservative, but then they run the risk of disappointing investors in terms of how fast they're scaling. What's your take on that?
My take is always raise more money than you need. So,
Okay.
and a perfect example is, I was involved in helping create a company that we listed on NASDAQ, and we started the company with a $250,000 seed investment. We then
Okay.
raised 1.6 million in a pre-IPO round. Our IPO was planned to be 15 million. We got very lucky. We were a week before a big IPO in the same space as our space that was going to go public at, multiple billions of valuation. And we were going public at like 30, 40 pre-money. So our IPO was heavily oversubscribed. We hit the full cap.
Wow.
We raised 27.6 million. So almost double what we planned on raising. We didn't even know what to do with that amount of money. And then what happened is the stock, tanked a little bit after the IPO. And it was around the same time as GameStop. And we became like a meme stock, like GameStop style. Everyone rallied behind the company. The stock went up like 3-4 times. And the company managed to raise close to 40 million in a secondary and warrant conversions. So this small company, in a period of 14 months, raised $70 million. They still have 48 million in the bank today, 2.5 years later. And, in this market, cash is king. I was with the CEO for dinner last week, and he told me he's looking at opportunities that were $20 million for like $2-3 million investment now, because he's got so much cash, a low burn rate. And so I'm a big believer, and people always say, I don't want to raise too much money because I don't want to give away too much of my business. Don't worry about dilution. I tell founders of companies, dilution is your friend, it's not your enemy. I said, if you're getting someone to pay fair market value or true market value for your stock, and you can have more cash than you know what to do with, you can never have enough money and enough health. So it's very important to raise more money than you need. Bank that money and park it aside, because you never know when a situation, a perfect tsunami like we have today in the markets, where it's a buyer's market and companies that have cash are king. And so I think it's important to watch your spending. To answer that question, it's very important to watch your spending. It's very important to raise more money than you need. If you need to raise 5 million, raise 10 million. If you need 10, raise 20. Go after it. Don't say no to capital that's coming in.
Right. Yeah, I think that's a very good point. And I think dilution is something that a lot of people who are founders of companies worry about. And it is a very delicate balance, of course. But, certainly sometimes people who are founders underestimate how much risk somebody is taking in investing in their company. And yet at the same time, other people perhaps err on the side of giving too much away just to be able to get funding. How would you approach that? What sort of guidelines might you give someone for that?
My guidelines are very easy. I have a really easy thought process on dilution. And my thought process is, I myself as an investor would rather own 5% of a company with 100 million in the bank than 50% of a company with 10 million in the bank. 100%. Dilution offers two things. It offers you the ability to have way more money in the bank than you need to have. It gives you dramatic liquidity. And, the ultimate game plan, if you're going public, it's not just to raise money. You have in the back of your mind a potential exit down the road. You want to take money off the table. And when I say to founders, it doesn't mean when you go public, you're selling your entire position. If you owned, let's say 40-50% of the company pre-IPO, and now you own 30% or 35%, you're still the CEO or the chairman. You control the board. You have all your close allies on the board. You have stock options. You have a salary. It's your business. You're running it. You're the biggest shareholder. Shareholder activists are not looking to take over smaller companies unless you're, like a Herbalife or some massive company. So my belief is, dilution brings you more money. It brings you more liquidity, which allows you then to sell some of your stock and take money off the table. And there's nothing wrong. I tell founders, if your stock is liquid and investors are selling their stock and they're making money, no one will care if you sell down part of your position and take money off the table. Maybe you want to pay your mortgage off. Maybe you want to pay for your kids' college education. Maybe you want to buy a vacation home. I don't know. Everyone has reasons, and no one cares. Just plan it properly. People are scared always that if they think that, oh, well, if I'm selling my stock, it's going to send a bad signal to the market. Yes, if you're selling all your stock, it's a bad signal. But if you own 50% and you announce that you're going to sell every day, no matter what, 10,000 shares in a selling plan that you've notified the market and the broker about, no one's going to care. And so I would say, don't be afraid of dilution. Don't be afraid of not controlling 50.1% of your company. Worry about meeting your business plan and growing your business.
Right. Yeah, I think that's a really good point. I think people do, in some cases, become too attached. It becomes their baby, and they have an emotional attachment to it that probably, as you're pointing out, goes beyond the relationship that you perhaps should have with a business being an actual separate entity. So I think that's very interesting. Now, I just wanted to bring around back to the point where we were talking about growth versus profitability. I know initially you're pointing out that investors are really looking for something that has a revenue stream. You've been able to convince people to buy your products. But as we're seeing with a lot of startups, they never really get to profitability. I mean, at what point do investors lose patience? You know, how many more rounds can you get where you just keep growing revenue and all that's great, but and we, you know, there's many cases that obviously everybody knows about, and I don't want to call any company up and put them in a bad light, but where there just seems to be year after year after year of losses, and yet revenue's growing. I mean, at what point do investors start to pull the plug on that and say, you know, we got to get to profitability?
I think investors, you know, the patience of investors and patience of hedge funds has changed dramatically. You know, long term used to be 5 to 10 years. It's now like 2 to 3 years.
Right.
So the time fuse on what is long term has changed. And I think that you have these brands today that people can create a direct to consumer or an e-commerce brand overnight.
Right.
And through marketing with influencers and through celebrities, they can, you know, hit the masses and generate revenue and profitability very quickly. And you see certain companies that scale up too fast, like Forever 21, for example, was a perfect example. You know, they went and they started growing and they were profitable, and then they just realized, okay, let's go and take over the market. And they grew way too fast and they couldn't turn a profit and they went into liquidation. And so I think that's what's happening. And what you're seeing now is a big paradigm shift. You're seeing a lot of the, you know, bricks and mortar well-known brands now turning online. And you're seeing influencers and celebrities buying brands, like, for example, Radio Shack or Pier 1 Imports, for example, or Bed Bath & Beyond. A lot of these brands, Dress Barn, for example, people are buying the trademark and the name and the brand and taking it onshore and close JCPenney and closing down all the stores. Less and less people are going to shopping malls. People are buying online. So I think the shift is investors are losing patience. You know, if a brand cannot reach profitability or be turned around, then, you know, they're on the chopping block and that's it. And they'll try and slice and dice it, and someone else will try and buy it out and turn it around if they can. You know, like Forever 21 went to a group that is in the similar business, but, you know, they watch their profit margins a lot higher than, you know, previous owners of Forever 21 did.
Right. Yeah, I think it's going to be interesting to see what happens in the next year or so to some of these D2C brands, and that never worried about, I shouldn't say they didn't worry about it, but there was less concern about profitability than there might have been with an established brand. So it's interesting to see how that's going to play out, and at what point investors start to see that there may be better opportunities for their money than another round of funding.
No, exactly. And I agree with you. You're seeing it now every day. There's someone else going out of business, someone else taking them over, and everyone's turning into an activist all of a sudden. You know, these long-only funds are now short funds. Everyone's become an activist all of a sudden. Even smaller companies are becoming, you know, targets of activists as well. So the landscape is definitely changing.
Yeah, it's interesting. I just wonder how all of this is going to play out. I do think that we're probably going to see interest rates being, well, above zero for a while.
I think it's definitely, I mean, you can see already mortgage rates in the UK are well over 6%. And even if you're willing to pay 6.5% or 7%, good luck getting a mortgage. You know, they've changed the rules here. The rules are now, before it was an asset-based loan, now it's an affordability loan. So I think it's going to be a lot more difficult. The cost of borrowing is going to be much higher. And banks are not going to lend money as easily as they lent money before. It's going to be a difficult climate right now, definitely.
So it'll be interesting to see how that impacts on investors. Now, just for my own edification, because some of us who don't work in the financial sector are not necessarily clear on the different aspects of funding. Now, you have, of course, venture capital, which is a very high profile, but what's the difference between that and angel investing?
I think the only difference between venture capital and angel investing is usually the first round of investment. So you've created a startup, it's brand new, it's a back of the envelope idea. You might have just incorporated your company, and your first port of call would usually be friends and family, which is almost the same as an angel investor.
Right.
Or an angel investor. It could be you have worked for a big company and the founder of that company had a huge exit and made a lot of money, and they are an angel. They're giving you your first 100 grand or 500 grand. I would say angel investors are bigger investors writing anywhere from $100 to $1 million investment, and
right.
your first port of call. And a seed investor would probably be your second round of investor. It could also be a first round investor. There could be an angel who says, I am putting my support behind your venture, and I'm going to bring 10 of my friends or 8 of my friends, and we're going to do a seed round together. And they'll come in at the same level. Like, for example, Amazon, Jeff Bezos went out to about 60 people, and 20 people gave the first a few $1 million, which was 20% of Amazon when it first was created. So I think that would have been a seed round. And then venture capital funds can invest in seed rounds too, but a VC round is usually once you've done your friends and family or your angel or seed round. Sometimes venture capitalists like to call themselves incubators and accelerators. And so what they'll do is they'll create almost like a competition or a contest where you'll present to a panel and they'll give you like a small grant or a small, convertible loan of 150, 200 grand into the business. And they'll run you through a process they have to see if there's viability or if the project has merits. And they'll put a mentor on, or they'll put a partner in the venture capital firm. And when I say mentor, it could be a previous venture that they funded, another startup founder that's been successful, and they'll mentor you, he or she, and sort of help you through the growing stages.
I think that's really interesting. So if you're someone who has a business idea, a startup, at least from your point of view, it looks like there's viability. You have found a few people who are willing to pay for the product, and now you're thinking about raising capital. This can be a very, very difficult challenge for people who don't have that experience on the finance side of things, right? How do they go about it? What do you do?
It's not as complicated as it sounds, and people seem to think it's very complicated. I think the first port of call is you want to have a good lawyer. Hire a good securities lawyer, someone that's a corporate lawyer and securities lawyer that can help you incorporate your company properly and understands what it takes to deal with fundraising, whether it's a crowdfunding, angel or seed investment, venture capital investment. That lawyer will usually have a good source of contacts. I like to look for, smaller to medium-sized lawyers, not the big, law firms. And usually they will have a network. They'll be able to make introductions to smaller brokers, smaller investment banks, crowdfunding portals. They might even have some investors that they think would like the deal because they know who's writing checks in their other clients' companies. These lawyers will have 50 clients like you. You're not unique in the sense, and so you want to be one of 50 rather than one of 2. For this lawyer. And so they'll be able to introduce you to. But like I said earlier, there are loads of crowdfunding portals you can go to, and they explain the process. It's not a complicated process. It's hiring a lawyer, hiring an accountant, hiring an auditor. You can hit the ground running with, a $10,000 to $20,000 investment in the process between lawyers, accountants, and auditors. Setting up a company today to go and raise money and opening a bank account, costs almost nothing. There are even a perfect example is Stripe. Stripe, who's the payment processor. They've created a company called Atlas Stripe where you can go online and create a corporation immediately. They'll even apply for you for your EIN to get, your tax ID code in America to have the ability to open a bank account. They'll set up your payment processing for you. They've done that as a tool to get people to create companies to use their services. Right. And so very easy today, $400 or $500, you can set up a business and then you can go and hire a lawyer and hire an accountant. So I think it's very, very easy. And, just look up online. There's multiple services available that offer the ability for you to go and raise money and learn how to raise capital.
I think that's really interesting, and I think that so many people really don't know how to go about it, and because they don't know how to go about it, they don't. So, yeah, I think this is just great. I mean, you've shared so many interesting things, Ron, and you've really given us such an interesting look inside how companies, particularly some of the smaller guys or mid-sized guys, can raise money. Where can people connect with you? I think a lot of people would want to be able to reach out to you.
Thank you. And so people can go to my website, which is www.thescapital.com. They can reach out to me. Someone from my team will make contact. We're happy to hear ideas and pitches from founders. We also, offer mentoring services and advice as well. And, I've worked with 50, 60 CEOs and founders over the past 20 years. We work right now with a portfolio of 15 companies. And so we've seen, the good, the bad, and the ugly, and we know what's going on in the market right now and how to overcome and tackle the current climate and problems. And, we're very happy to speak with anyone and have set up a discovery call. And, and thank you so much for having me on your podcast. It's been fantastic.
Well, Ron, it's been a total pleasure. I will include all those links in the show notes because I know sometimes when you're listening to something, you might not have a pen or a paper right at hand. So all of that will be in the show notes for people. And again, thank you for taking the time to join us.
No, thank you so much for having me. It's been an absolute pleasure. I appreciate it.
I'd also like to thank our sponsor, AsiaNet Consultants. AsiaNet's a specialist in recruiting top talent in Asian markets. Since 1988, AsiaNet has been working in partnership with its global clients to help them make the right strategic hires. They have a well-earned reputation for being able to fill even those difficult-to-fill positions. Learn about how they can help you find the best talent by heading over to their website, asianetconsultants.com. That's asianetconsultants.com. I'll also leave a link in the show notes. Thank you for joining me here on A Seat at the Table. If you enjoyed this episode or learned something from it, I would love to hear about it. If you'd like to support the show, please hit the subscribe button. And if you can take a minute to leave a review on Apple Podcasts or other channels, that would be fabulous. Don't forget to check out our podcast website, seatpodcast.com. That's SEAT podcast.com. If there's something you'd like to share, ideas, suggestions, or comments, please feel free to reach out. I would love to hear from you. Thank you again for joining me and being part of our international community. I'm Jane Singer, and I'll see you in the next podcast episode.